Good morning or afternoon, depending on where you are joining us from today. My name is Ed Redder. I'm a partner in the Thompson Hine Employee Benefits and Executive Compensation Practice Group. I would like to welcome you to today's webinar. I'm fortunate to be joined by Dominic DeMattis, a partner in our benefits group in our Washington, D.C. office. From now until approximately 1 o'clock, we will share our presentation regarding the latest developments and related considerations for retirement plans in a COVID-19 environment. During the webinar, please feel free to use the question box typically located in the control panel to the right of your screen to submit questions. We will answer questions at the end of the webinar and will continue to remain online until 1:15. If we cannot get to all the questions during our during our time together, we will respond via email after the webinar. The webinar is being recorded and we will send a link to all attendees early next week. With that, we'll start our presentation. As an overview, we're gonna discuss the Coronavirus Aid, Relief, and Economic Security, or CARES Act, which is widely expected to be signed into law today. Plans already have certain tools available to enable participants to access funds while employed. So we're going to discuss other generally available 401k and pension distribution options on our call today. Again, many companies are facing unprecedented financial difficulties and stress as a result of the measures taken to respond to the pandemic. So we're going to spend some time and discuss options for conserving company cash. And then finally, many of the measures taken by companies today will cause financial strain and may trigger certain other compliance obligations and other considerations for plan sponsors and plan fiduciaries. As such, we're going to address those other employer considerations and potential traps. With that, I'm going to introduce Dominic, who's going to cover the CARES Act.
Thank you, Ed, and thank you, all of you, for joining us. The CARES Act, as you know, is a huge piece of legislation that's making its way through the House right now. It's actually being debated in the House. And assuming they are able to get through debate without an objection to there not being a quorum in the House, it would pass today, and the president has said he will sign it. If there is an objection, that does not mean that the bill won't pass the House. It simply means that there needs to be enough members in the House present to actually vote in favor of it, 218. So it would cause a delay in the passage, but the speaker has said that it will pass, and therefore it will pass. It's just a matter of whether it happens today or whether maybe it takes until tomorrow. So, you know, our focus, obviously, this is a large piece of legislation that has many different facets to it. We're just talking about, you know, our piece in the employee benefits world. In addition to some of the stuff we'll talk about today, it's outside of scope, but just wanted to mention that the CARES Act also includes provisions related to COVID-19 testing, preventative services, use of HSAs and FSAs and HRAs for certain over-the-counter medical products, and privacy of medical records. So you'll want to check with your friendly healthcare folks on that. It also includes a provision related to educational assistance programs to allow certain types of student loan repayments to be made during 2020 by companies. But our focus for the remainder today is going to be on these retirement provisions. So there's two main retirement provisions that get a lot of the press, if you will. It's the first one here, these coronavirus-related distributions, and then these enhanced participant loans and delayed repayment provisions. There's also a waiver of the required minimum distributions included in the bill, and there are some provisions regarding flexibility on timing of funding and benefit restrictions for defined benefit pension plans that we'll talk about a little. So turning to these new distributions, the coronavirus-related distributions, these are the very expansive distribution option that's available. it's important with respect to both this hardship distribution option and, well, I'm calling it a hardship distribution option because it's modeled, for any of you who had the occasion to use it, it's modeled after prior disaster legislation that had passed Congress related to wildfires and certain hurricanes during the past couple of years. But it's never been widely available on this scale. Those are far more limited uses with far fewer participants and plans affected. And as you'll see as we walk through the provisions here, these are potentially very, very broad and far-reaching. And I kind of, it's a new tool, it's a new option. But, I think be careful looking through these and be careful considering these. There are some folks, and some of you have folks, or maybe even yourselves, obviously are in very serious circumstances. And so, this type of a brute force tool or these brute force tools may be necessary. They may be the best option. But as Ed had pointed out at the beginning with the overview, we thought it was also important to remind you that there are tools available currently under existing law that, maybe are better for a particular situation, and, you may want to consider. So after I get through walking through these and then Ed talks about some of the other things in the CARES Act, he'll also walk through some of those other tools that are available. Getting to these hardship distributions, these coronavirus-related distributions, it's simply a distribution of up to $100,000. That's an aggregate limit for all plans within a controlled group or affiliated service group. It's also an individual limit for a person. So if the person takes $50,000 from an IRA, they can only take $50,000 from a plan. A plan is not required to track that. The only thing the plan is required to track is within its controlled group that no more than $100,000 of these distributions go out. They're called coronavirus-related distributions, but as you'll see, if this option is added to a plan and an individual is eligible, there's no real restriction. There's no proof required. You don't have to come up and say, well, here's the hardship I'm going through, or here's the difficulty I'm experiencing, or here's the additional financial consequences to me of the current situation. You simply need to be eligible. So first, the distribution up to $100,000. Very tax efficient. No 10% penalty for the early distribution. So if it happens early under your plan, no 10% penalty. You pay income tax ratably over a 3-year period. That's the default. The participant pays over a 3-year period. A participant can obviously elect to accelerate that. If the participant wants to, they may recontribute the amount to an eligible retirement plan within 3 years of the distribution. It doesn't count in the 402G limit. It doesn't count as an annual addition. It's just simply recontributed almost as if it were a loan. It's not entirely clear exactly how that will occur. I'm sure there are going to be many questions and implementations as to exactly how that is done. We have some ideas as to how we might do it, and we have some ideas as to how it might be interpreted by the regulators, but we haven't quite heard yet exactly how in particular in this case, Treasury and IRS are going to interpret this and what they may require or how that may work, this recontribution. The fifth bullet there, these distributions are not treated as eligible rollover distributions. So, we know what that means for A31. That's the basic requirement that that a plan offer rollover, and 402F is the notice requirement, so you don't have to give that because it's not an eligible rollover distribution. Under 3405, what that means is that these distributions are not subject to the mandatory 20% withholding that would apply to an eligible rollover distribution that's not paid in a direct rollover. So what that means is that these are non-periodic distributions under Section 3405, which is a default 10% withholding, but a participant could elect out of that if a mechanism is set up for them to do so. These are distributions, any distribution made on or after January 1st, 2020 and before December 31st, 2020. Maybe that should say on or before December 31st, 2020, are, can qualify for this if the person is eligible. And the main purpose of that, you may say, well, what's this backward-looking thing that's kind of bizarre? The main reason for that is because if a plan wished to, you may have already had folks who took hardship distributions who would qualify for this type of a distribution, so that if you added it now, they may be able to get more favorable tax treatment on that prior distribution. And so that's something to think about, the mechanics and the administration of doing that and making sure that your plan documents would allow it. And so there's some I's to dot and T's to cross, but that's the intent in allowing the essentially retroactivity of these distributions. They also are available in service under a money purchase or defined benefit pension plan at age 59 and a half. So one could offer this, but consider that that's going to depend on individual factors or circumstances with respect to your defined benefit plan. Whether or not you actually want, there's a desire to allow additional cash to leave more quickly. But the point being that the age 59 and a half, which is 401A36, still applies, in contrast to the early distribution penalty and the general requirement for, like, for example, a 401k plan that one can't distribute before, certain ages. Those are all lifted for this. So that's the basics of the distribution. So who's eligible? Well, who's eligible is anybody who's diagnosed with COVID-19, anybody or their spouse, or, and the second prong here is, the broader one, obviously, it's anyone who experiences, as a result of the pandemic, adverse financial consequences as a result of being quarantined, furloughed, laid off, having work hours reduced, unable to work due to childcare, closing or reducing of hours of a business that the individual owns or operates. So, this is a pretty broad group of people because there's a lot of people out there who have experienced adverse financial consequences. And there really is no definition as to what that means. And plan administrators are permitted explicitly under the bill to rely on an employee certification that they're eligible. So that's the distribution option. For plan loans, this is the basic idea here is a plan can allow larger loans and there can be an automatic forbearance. So, and it's interesting. So the larger loan is, I think, pretty easy to describe. Instead of a $50,000 limit, it's a $100,000 limit. Instead of being able to borrow up to half the accrued benefit, you can borrow the whole thing. So that could be a pretty big loan. And that's only for loans, again, within 180 days of enactment. Now, the delay is a little more difficult, at least to completely understand what's intended by the language in the bill, and may ultimately require some guidance from Treasury and the IRS. In the way it appears, in the way it's drafted, it appears that it may be required for all loans, that you have to delay all loans. But I don't think that, my personal opinion is that that's not what is intended. Certainly new loans with higher limits, those loans, there's an automatic forbearance. I think that's clear. But with outstanding loans, I think it's tricky. And the reason it's tricky is because there's no way to know with respect to an outstanding loan whether or not somebody is eligible for this forbearance unless they come and tell you. That's the only way you're going to know. So from my perspective, that may think about, you may want a communication strategy. You may want to be reaching out. You may want to think about how you're going to do that. But there will be people who are eligible for the forbearance, but you're not going to know unless they tell you. What happens with the forbearance basically is any repayments due between the date of enactment, which is likely to be either today or tomorrow, and December 31st will be delayed for 1 year. That period is disregarded for the maximum loan term. And subsequent repayments are adjusted appropriately to reflect the delay in accrued interest. So who's eligible here? Well, the definition of eligibility is the exact same people who are eligible for the coronavirus-related distribution. There isn't anything explicit, unfortunately, in the statute that talks about self-certification on the loan side. But, you know, so it's open interpretation, and I think people are going to disagree. You know, but I think as you read the language, it's because of the reasons I described before that people have to tell you. There's no other way to know unless they come and tell you. And then at that point, I don't think you're going to want to be in a position of collecting, you know, personal health information from them regarding whether they've received a certain diagnosis. There's lots of good reasons not to do that. And for those of you who care about ERISA issues, you know that there's an adequate security requirement buried within Department of Labor regulations that is not modified here. So potentially appears one could violate that, although I'm quite certain that at some point in time, the Department of Labor will find its way to make it clear that there's no violation. And with that, I'll turn it over to Ed to talk about the next couple changes.
Thanks, Dominic. I would also add for plan sponsors that they really ought to be on the lookout for communications from their service providers, record keepers, TPAs, about these potential enhancements, because it's very likely that the enhancements will want to be, there's going to be a desire to roll these out, I think, fairly quickly. And so we all ought to be on the lookout for communications, opening up dialogue with our service providers to understand when and what will be implemented. With that, though, we're going to turn to another important provision, and that is the temporary waiver of required minimum distributions. So it's important to remember how these minimum required distributions are calculated. Remember, when we're calculating a required minimum distribution for 2020, we're looking at the value of the account last year, so in 2019. And we need to remember what happened in 2019. We had really an unprecedented run-up in the value of assets within plans. And so we have this kind of significant impact of the sudden and large downturn in the market that would force folks to take significant distributions from their plan accounts at a time when the values of their plan accounts are depressed. And for that reason, the Act would provide this temporary waiver of required minimum distributions for the calendar year 2020 for defined contribution plans. And it's also important to remember we do have some precedent for this happening. If you may recall, back in 2009 during the Great Recession, there was also relief provided for required minimum distributions that's similar to this relief. And so, again, the requirements under Code Section 41A9 do not apply to calendar year 2020 for DC plans, including 403B and 457 plans, B plans maintained by governmental entities. It's also important to remember that the requirements are suspended for distributions required in calendar year 2020 as a result of a beginning date occurring in 2020 and which hasn't been made prior to this calendar year. And so let's look at just a quick example of how that works. So if we have a retired participant that attained age 70 and a half in 2019, and remember, that person would still be subject to the old rules of the old required beginning date because they attained 70 and a half in 2019 and not the age 72 that applies after 2019. And so they would ordinarily be required to commence distributions by April 1st of 2020. Now, in reality, many of those distributions have already occurred, but based on the Act language, it would delay that distribution as well as the later distribution for plan year 2000 or calendar year 2020 due later this year. The provisions also waive, again, the 2019 minimum required distributions that were not made during 2019. And then finally, we disregard 2020 for purposes of determining the required beginning date after 2020 and for the 5-year distribution periods under 401A9. Plan amendments. this is always a question that comes up when we get this sort of relief and these sort of options for plans. There was back and forth, but the most recent language of the Act provides that plan amendments, formal plan amendments, are due by the last day of the first plan year, beginning on or after January 1st, 2022, or for all but the change to minimum required contributions, such later date as the Secretary of Treasury may prescribe. For governmental plans, which is often the case, we have an extended deadline, and that's due by the last day of the first plan year, beginning on or after January 1st, 2024. Keep in mind, though, whenever we have this kind of extended period in which to adopt formal plan amendments, we do need to have operational compliance with the requirements. And with delayed formal documentation of amendments, it's always important to make clear and document precisely how you're operating in practice, because you'll want to have good information, good detail on the formal amendment language when you do ultimately formally amend the plan. So that's a quick run through the CARES Act and some of the major provision of the CARES Act. We will be touching on a few other retirement plan related provisions of the CARES Act later in the presentation. But now we really want to turn to kind of existing provisions. So as Dominic pointed out, there are a lot of questions, I think, that remain with the new optional distribution provisions and the loan provisions. We all ought to keep in mind that we do have tools already existing to allow some flexibility to allow participants to access their plan accounts currently while they're employed. And so we wanted to address that and discuss some of the issues related to those provisions now and some considerations that employers ought to keep in mind. So first of all, this is always the starting point with all of these discussions. Focus on your plan terms. Review your plan document to see what's available under the current plan terms. Many 401k plans allow for participant loans. Many 401k plans allow for other non-hardship in-service withdrawals, and we've listed some of those there. We also have hardship distributions. It's important to keep in mind, hardship distributions are a topic that have come up from a variety of folks over the last couple weeks. And there's some, I think, misunderstanding or misconception of whether the new hardship safe harbor would apply at this point. So we've worked through this issue, and it does appear that the safe harbor hardship for disasters does not appear to apply nationwide yet. And so there are exceptions. We've had federally declared major disaster areas in a variety of states. And so we've listed the states, at least within the last 24 hours, that have had declared major disaster areas. And so it could be a hardship, immediate and heavy financial need, a safe harbor in those areas. But keep in mind the other immediate and immediate and heavy financial need safe harbors. So to prevent eviction, for medical expenses, there are other provisions, while not directly related to COVID-19, may be options for plan participants to access their funds currently. Consider changes. So we've talked about taking stock of what's in our plans currently. If you don't have these provisions in the plan, or if you have provisions that are more limited than what the law would permit, you may want to consider changes to those provisions. So what are some examples? Well, with participant loans, you may want to consider the loan repayment suspensions for unpaid leaves. So I know one of the unfortunate events that is occurring for many employers is the need to furlough folks or put them on an unpaid leave of absence. Remember, there is provision in the regulations that would allow for suspension of up to a year for unpaid leaves. Consider the maximum cure period. While many of the plans provide the maximum cure period under the regulation. So in other words, the last day of the calendar quarter following the calendar quarter in which a default occurs or a delinquent payment occurs, some are more restrictive than what's permitted under the regulations. And so you may want to consider maximizing the cure period for participants. You also may want to consider the number of loans available. You can expand on the number of loans that are available under a plan. Finally, continued repayment, ACH, when not being paid. So many of our employees may be on unpaid leaves of absence, may be have to not be receiving a paycheck, and so consider whether there are options to provide participants the option to pay outside of the normal payroll deduction process. And then, as always, you need to coordinate carefully with your record keeper and make sure the administrative systems can sync up with whatever changes are being made. Other potential changes, in-service withdrawals. Again, you may want to consider expanding sources for non-age 59.5 distributions. You may want to consider the addition of age 59.5 distributions. You may want to consider changes to hardship sources. Remember, we did have the final regulations on hardship distributions finalized last fall, which expanded some of the hardship sources available, or some of the sources available within accounts for hardship. They also relaxed some of the requirements. But remember, some of those changes were not mandated under the final regulations. And so plans could continue to impose certain additional restrictions that were not required under the hardship regulations. And so it may be a good time to reevaluate any of those restrictions that you maintained in the plan to consider whether to eliminate those and expand it as much as the regulations would permit. Now, with all of this, just a word of caution. Once certain distribution options are added, they become protected benefits. And so what that means is you may be restricted from eliminating them later on and may need to preserve those distribution options unless you decide to bifurcate and restrict it or expand it for prospective contributions only. With that, I'm going to turn to Dominic for a minute.
Yeah, thanks, Ed. Yeah, and on that point, the coronavirus-related distributions, they kind of, by the way they would be defined in your plan document, were you to add them, don't really become protected in a way. It's not, in other words, it's not as if long-term, should there be some other pandemic, that provision in your plan would automatically kick in and allow further distributions. Instead, it's a limited kind of a distribution window, if you will. And so that's one way to think about if you were to add additional distribution options along the lines that Ed was talking about, you know, consider whether or not it's permissible and consistent with your plan and with your culture to add something temporary as opposed to permanent. With the other assistance options, we thought it was important. We both of us and our group generally, and a lot of you, folks are all over the map in terms of how this affects them. We know that some businesses are I hate to say thriving. They're doing very well, economically at least, from the perspective of, the economic shift that's occurred based on, our current circumstances, whereas others are not doing so well. And on this page, I think we're a little bit more focused either, on those that, economically have the additional resources and are trying to figure out ways to help and incentivize employees, or those who, have enough to do it and recognizing that their employees are in many cases performing heroic efforts. Now I've had some folks talk about adding additional discretionary contributions to, say, a profit sharing plan or something like that. And, just to keep in mind, there's plan terms that you need to worry about and make sure that they're consistent with this. But, adding an additional contribution is generally very easy to do, and it can be discretionary, and it doesn't stay and it doesn't require future contributions generally. So So again, as Ed pointed out, it's about looking at the plan document, figuring out what's already permitted, and determining whether or not there would need to be a change. One way to think about this, and I've had some who've thought about it this way is, we've got folks who are working crazy right now, and sure, yes, we know we can give them additional cash if we have it, but they're also looking at their retirement balances, and they're bouncing up and down, and they've gone more down than up, even with the recent few days, although I guess it's dropping again today. And, another way to think about these types of additional contributions, even though they're not cash in hand right this moment, it can be a way to help somebody have the feeling, at least, and in reality, you're adding more cash to their retirement account, potentially softening the blow of wherever this market volatility leads us. So that's something to think about. Another thing to think about is really it's not a retirement plan, it's more of just the general compensation arrangement. There's this neat little provision in the Internal Revenue Code regarding qualified disaster relief payments, which is currently applicable. The national emergency that was declared is sufficient to trigger this. So, this is a very extremely tax-efficient way. There's no income tax, and it's deductible to get some targeted relief to employees who are facing financial pressure as a result of the current circumstances. So what you can do under these type of arrangements is you can pay or reimburse any reasonable and necessary personal, family, living, or funeral expenses incurred as a result of a qualified disaster. And so that's the quote from the language in the Internal Revenue Code. And a qualified disaster for this purpose has, a national emergency that was declared nationwide has been interpreted to be a qualified disaster that fits into this definition. Importantly, you can't pay for lost wages or PTO. You're not paying for sick time or wages, nothing of that type. But things that are not covered by insurance, perhaps childcare, tutoring expenses, funeral expenses, even perhaps like hand sanitizers and disinfectants, or even providing them in kind and not worrying about whether or not you've given somebody compensation. These are all permissible under this type of an arrangement. You need to be sure, if you are interested in this, that it's set up correctly. And so it generally requires a written plan document, and it needs, clear administration, and you obviously want to be very careful with it. But it might be a good option for folks who find themselves in a situation where they either have enough available or they feel like they need to make choices in order to help some of their employees at this particular point in time. One other thing to keep in mind, it's outside the scope of what we're talking about today, but non-qualified deferred compensation arrangements obviously can get very tricky. Just be very careful if you're considering any changes in reaction to what's going on. In particular, like a modification to a stock option, just be very, very careful and make sure that you're consulting with folks on that. And also under, say, a general non-qualified deferred comp plan, there might be ways to set up, like to shut off deferrals effectively. It's not, you wouldn't really call it that, but there's ways potentially to shut off elective deferrals, but it would be highly dependent on your plan terms. And you really don't want to blow those arrangements up. So again, if you're considering those types of changes, that's something to, all this stuff, you really want to make sure, obviously, you do it right. But in the consequences of blowing up under 409A and some of the other tax rules can be so significant, as I know many of you know. Ed?
Thanks, Dominic. That's great information. Now we're going to shift a little bit. We've really focused for the first half or so of the webinar on providing more flexibility to plan participants to access funds, and certainly that's an important consideration here. But now we're going to shift to a discussion on issues for employers and employer cash preservation, because obviously with the current situation, with the restrictions on business in many areas of the country, employers are also facing very difficult financial times. And so we want to focus on some steps that may be taken into consideration by employers to help preserve cash and funds at this point in time. And so let's talk about some of these employer considerations. So first of all, for a defined contribution plan, consider some design options that may help free up cash. So if you have a defined contribution plan, you have non-elective contributions, you have matching contributions, consider reducing or eliminating employer contributions. It is permitted generally. You do have to, though, be careful to consider any protected benefits issues. And so generally, you want to look to see, look to the plan terms. Again, that's always the first order of business with any of this. Look to the plan terms to determine what are our allocation periods, have the benefits accrued. So in other words, have folks already satisfied the allocation requirements for benefits or for a contribution. So many plans have a last day of the plan year or last day of the contribution requirement. Some have, being credited with 1,000 hours of service during a year in order to qualify for certain contributions. So it's important to focus on those allocation requirements to make some determination as to whether those benefits have already accrued. You also want to consider any waiver provisions. So for instance, if you have a last day of the plan year requirement, but there's waiver provisions for those who die or retire on or after normal retirement age, those are things you're going to want to focus on and consider to analyze whether certain folks have already have had benefits accrue under those types of arrangements. Clearly, we'll have to amend the plans to affect those changes, and generally you're going to have to amend those plans in advance of the elimination of the contribution. You're also going to want to advise folks, provide written notice to participants of the elimination of certain contributions, so that they can, certainly if they're matching contributions, that they can modify their deferral elections accordingly. Many plans are safe harbor plans, either have a safe harbor matching formula or a safe harbor non-elective contribution formula. So we really do have to focus on the additional requirements that are imposed on those types of safe harbor plans. And so it's important to ask whether your safe harbor notice reserves the right to suspend safe harbor contributions. This is a provision put in place, and many employers in their safe harbor notices have added the language to reserve the right to suspend safe harbor contributions. If not, it's not fatal. The question that has to be asked, though, is as to whether the employer is operating at an economic loss. And so there are some considerations, but you want to carefully review the safe harbor provisions to see, safe harbor notice provisions to see if that language is currently in your safe harbor notice. You're going to have to make provide that notice, a supplemental notice, at least 30 days in advance of the effective date of the amendment. You'll also have to amend the plan to put in place non-discrimination testing. And the non-discrimination testing must be conducted for the entire year using the current year testing method. So there are implications of suspending the safe harbor contributions. And remember, if safe harbor contributions are suspended, and given the economic times right now and certain struggles for employees, there may be a pretty dramatic impact on your ADP and ACP testing results by virtue of certainly lower paid folks trying to conserve assets as well. And so it may have an impact on your testing results. And then consider other options for reducing contributions, such as changes to auto enrollment and auto escalation features. Dominic?
Yeah, thanks, Ed. The other things, when you consider with your defined benefit plans, some folks may be thinking about, those of you who, if you have active accruals, may be thinking about freezing benefit accruals or certain components such as benefit service. Just be careful with that. Obviously, there's 204H requirements, and also many of the formulas, at least in many cases that I come across, are also collectively bargained. So there are concerns and issues there that you need to consider. Generally, you can't, lump sums are a protected benefit. So, like, for example, if you're in a situation, where the pension plan has gone through extreme losses and there may be a desire to kind of impose benefit restrictions a little early, that's not something that you can do. Lump sums can be taken away prospectively for future accruals, but boy, that's messy. But we will discuss a provision of the CARES Act a little later that might be relevant. For example, if you want to keep benefit restrictions in place during 2020 that were in place during 2019. Ed?
Thanks, Dominic. So we've talked about certain plan design changes that could be implemented or at least considered to help conserve funds, but we have to keep in mind also that there may be other population changes, workforce population changes that could have, indirect impacts on our retirement plans. And so we wanted to address some of those issues and considerations now. So remember, think about workforce changes that may be implemented. Evaluate the impact of those changes on retirement plans. So some employers may or already have considered furloughing employees. And so it's important to keep in mind how those furloughs are treated. So I think it's a kind of an imprecise term. Some folks view that as a termination of employment. Others view it as an unpaid leave of absence. So I think it's critical to make sure you understand precisely what's happening and how those workforce changes or decisions that are implemented impact your retirement plans. And so that issue could directly impact what distribution options are available. So if we have a termination of employment, we will typically have a distribution option or a distribution event that would allow distribution of a 401k account balance anyhow. If, on the other hand, it's an unpaid leave of absence, you'll have to consider what distribution options may be available, including plan loans and hardship distribution. So again, it's just important to keep in mind the details of those workforce changes so that you can consider in reviewing your plan document and the guidance what may be available. You should keep in mind how service crediting may be impacted as a result of those changes. Again, we already touched on participant loans a little bit, but consider how those workforce changes are going to impact participant loans. Are people being terminated? Will that termination lead to the full loan being due and a potential deemed distribution? If instead they're on an unpaid leave of absence, that we mentioned this earlier as another possible current option, but can we suspend those loan repayments based on the unpaid leave of absence? And then finally, we really do need to keep in mind also other implications and compliance obligations. So workforce reductions could ultimately lead to a possible partial plan termination and have other implications for defined benefit plans. So let's talk a little bit about partial plan terminations quickly, just to remind everybody of how they operate. So a partial plan termination would result in the affected participants being fully vested in their account balances upon the occurrence of a partial plan termination. So when does a partial plan termination occur? Well, it's presumed to occur if there's an event if there's a 20% or more turnover rate. And we look at the turnover rate, we calculate that turnover rate by looking at the number of participants with employer-initiated terminations and and dividing that by the sum of the employees participating in the plan at the beginning of the plan year and any new employees that became participants during the year. So we do really have to carefully evaluate which employees are included in that determination. It's also important to keep in mind for a 401k plan, generally your number of employees participating are those who are eligible, even if they decide not to defer to the plan. Also keep in mind, again, going back to the furlough issue, are those people truly terminated or are they on an unpaid leave of absence? So again, careful consideration of the numbers of participants and individuals that would have to be included in making that determination. And then generally, a partial plan determination is measured, the turnover rate is measured based on a plan year period. There are exceptions. There could be a longer period, potentially if there's a series of terminations that are tied to the same event or as part of a planned termination. So always important to keep those items in mind and discuss with counsel and advisors to confirm the analysis. There are other defined contribution plan administrative considerations. Remember, these events, these workforce reductions, potential behavioral changes on the part of participants will likely have an impact on non-discrimination testing. And so again, ADP and ACP results will likely be impacted. And again, as a reminder, and we covered this in a few slides ago, former safe harbor plans, so if we suspend mid-year, they're required to satisfy the ADP and ACP tests for the entire year. And it's important to remember also that top-heavy testing will be required. Then consider the impact on coverage testing. And I think this is an important one to keep in mind as well. So many plans rely on kind of the 3-year pass for coverage testing. So they pass coverage, they test in 1 year, and then for the next 2 successive years, they rely on that result. The ability to rely on that result, though, ends if there's significant changes in plan provisions, significant changes to the workforce or other compensation practices. So it very likely will end up require coverage testing, again, potentially sooner than you otherwise would normally have done so. Turn it over to Dom.
Yeah, so for defined benefit plans, this is the point in time, normally, like if we were doing this under normal circumstances and you were all in a crowd, I'd ask you to raise your hands if you cared about defined benefit plans, and I'd know how much time to spend on this, but I'm sorry, I can't do that. So we're gonna just play it straight down the middle. We'll touch it a little bit. And of course, if you have additional questions, please just ask about them. For defined benefit plans, I think it's a pretty easy tripwire. So for those of you who may be affected by losing active participants, it's not that hard to trigger an active participant reduction, which is a reportable event. So you definitely want to keep an eye on that because there may be reporting required to the PBGC. And the way active is defined for this purpose, just real quickly, is anybody who's basically receiving comp for anybody in the controlled group. Also is on paid or unpaid leave of absence other than a layoff, or is laid off for a period of time that's lasts less than 30 days, or is absent from work due to a recurring reduction in employment that occurs at least annually. So active is not what you think it is, in other words. It's not just people who are purely active. There may be arguments to include certain folks who may be on unpaid leaves, i.e. furlough, as still being active and therefore not triggering this. But it's just something keep in mind and to take a close look at. Another possibility is triggering what's called 4062E. It just refers to the ERISA section. These types of events occur when there's a permanent cessation of operations at a facility. So, if you're stopping operations temporarily in response to the pandemic, well, that's not a permanent cessation of operations. But if you do have a permanent cessation of operations, say for whatever reason in connection with this, the facility is shut down and not reopened, if that results in a workforce reduction of more than 15% in the total number of eligible employees, and eligible employees is defined as anybody eligible to participate in any pension plan, which includes defined contribution plans in the controlled group, then you may have a 46(2)(e) event, in which case there's reporting required to PBGC. There are some exemptions from that, but it's just something to keep in mind. The other thing the CARES Act did, or one other thing the CARES Act did with respect to defined benefit plans, is gave a lot of flexibility to plan sponsors in the timing of their 2020 contributions. So all minimum required contributions in 2020 are delayed until January 1st, 2021. So that's important. Lots of folks are in cash preservation mode, and that allows a deferral of these payments at the cost of interest, at your defined benefit plan's effective interest rate. The other thing that, and I alluded to this a little earlier, that CARES Act did is it allows plan sponsors to use their 2019 AFTAP for 2020 benefit restrictions. So now, this is, to me, this is mainly an issue for folks who either their actuaries or the decision makers are not available to timely determine the 2020 AFTAP, which is fast approaching for calendar year plans. And, without a determination being made, the automatic rule and the regulations would kick in to push down last year's AFTAP by 10%. Well, this is saying that doesn't have to happen. You don't have to do that. You can just use the 2019. It also is an issue for non-calendar year plans that may suddenly slide into benefit restrictions due to the recent market volatility. But, it's also an issue, and I think that those are the reasons why it was put in there. But from my perspective, it's an even more important tool for people who are maybe looking at their defined benefit plan and saying, boy, this may not, and when I say people, I'm talking about plan sponsors. This is a design choice. We're not talking about the fiduciaries. But this may be, a good time to say, well, look, we're not going to, we really would rather not have those lump sums being paid out. If there already are benefit restrictions for 2019, you can keep them. So that's another way to look at this, the possibility of using this. And so it's available. For multi-employer plans, for those of you who are making contributions to multi-employer plans, I'll just hit this really quickly. Again, if there are questions, pop them in to us. This is not likely by itself to trigger withdrawal liability. It's not that type of a thing. But I think the biggest issue for multis is going to be there's, obviously to the extent that a collectively bargained population is affected, there's going to be a significant reduction in hours and potentially, depending upon the collective bargaining agreement, a significant reduction in CBUs. Well, that, has that creates a problem for the plan. So if the plan was already in trouble with respect to its funding, this just further exacerbates the problem. But it also creates an issue, potentially longer term, if that reduction continues, where it's possible that over the longer term, a partial withdrawal could be triggered. And so it's something to keep track of and monitor and be careful. One thing I'll point out with multis, though, even though by itself, a temporary shutting of a facility due to a health emergency, should not be triggering withdrawal liability. Be careful with communications to collectively bargained employees, because sometimes those types of communications, depending upon how they're worded, can trigger all kinds of ire on the union side. So now you all have probably heard that the tax day is no longer April 15th, it's now July 15th. And so, with that comes, other changes that follow, but not as many as you might think. So yeah, with the tax deadline being changed to July 15th, that means that the deadline, or the grace period as it's called, under Section 404, which is where you get your deduction for contributions to retirement plans, that grace period is now also extended to July 15th. And it could be further extended if there's an extension to the tax return deadline for the corporation or the plan sponsor. But, it doesn't affect much else It affects some things on maybe on a more personal side or even on welfare side. It does delay the deadline for 2019 IRA contributions, and it also delays the deadline for HSA contributions. But it doesn't change things like, the requirement under 402G to kick out excess elective deferrals. It doesn't automatically push back the Form 5500 filing deadline. So at least not yet, these things haven't been pushed back. Now, what's our expectation? Well, it's only a guess, so we can guess about what we expect. So as far as I know, nothing's been published by the IRS today. But my personal opinion is I fully expect, and I don't think it's a surprise, that we're going to get pretty broad relief on a lot of deadlines and requirements that related to timing under the Internal Revenue Code for our purposes, including, obviously, I think, Form 5500 filings. My view is that there's already authority for the IRS to do that based on the National Emergency Declaration. I don't know whether they agree. They won't tell me, even though I keep asking. But even if they don't agree that the National Emergency Declaration does it, the more of these federally declared disaster declarations we get on a statewide basis, well, those clearly do it. Those declarations that are happening on a statewide basis are the exact same process, the exact same declarations that occur when tornadoes swept through Tennessee or a hurricane pummeled into Texas. I mean, it's the exact same thing. So there's a well-worn path here for the IRS where they've been extremely consistent about how they've handled these things. And, if you're curious, you can even go look back at the history there, where there is a significant delay in a lot of acts. But we won't know for sure until they tell us. Interestingly, the CARES Act did provide expanded authority to the Department of Labor to extend deadlines. And, my guess is the reason they did that is because even though IRS and Treasury have interpreted their statutory language to include a national emergency as being the same as a disaster for purposes of extending deadlines, the Department of Labor perhaps has never gone that far with their interpretations, and they either asked or somebody suggested that they be told to do it, and that's how it ended up in there. So that wraps up the employer considerations. Now, just a couple minutes on fiduciary considerations, because I know folks are concerned. Many of you either advise or serve a role with respect to investment committees, and you're thinking, whoa, the market's going up and down, and the 401k investments are going up and down. My pension plan investments are going all over the place, and you're concerned about that. And so hopefully this will be a little bit comforting in that respect, which is that look, at the end of the day, if you've got a good process in place and you're documenting what you're doing and you have advisors in place and you have experts there and you're asking questions and you're doing the ongoing monitoring and oversight, well, then you're doing what you can. I mean, I think the fact that there's short-term volatility, even extreme volatility, doesn't dictate that a certain action must happen, other than fiduciaries continue to do their jobs, which is to ask questions, such as, well, gee, how is that particular investment doing against its benchmark? What did we expect it to do? If it's not behaving the way we expect it, if the protection against downside risk hasn't kicked in the way we expect it to, why? And is this the right investment for us to be holding? That's the type of things that I think are, important to continue doing. But I wouldn't, want to, unless you just don't have a good process at all, in which case fix it. I wouldn't want to suggest to people that, this is a hair on fire and we must, change everything we're doing type of approach. Instead, hopefully you've got the process. If not, get one and follow it and be consistent and ensure that the fiduciaries are asking the right questions and getting good advice. I will say one small thing about blackouts. There's a wide range of opinions on this. My view, generally implementation of a blackout period is a fiduciary decision, and therefore the facts and circumstances have to be analyzed. So, presumably there was a reason why the blackout period was going to happen. It's presumably the result in many cases, not always, but in many cases, the result of a fiduciary decision that people need to move from one investment to another. So there's a question the fiduciaries ask, in this environment, is there sufficient additional risk in this environment, or would it otherwise not be prudent to go forward with that action? Or should we continue? You know, in many cases, the answer may be don't go forward, but not all. And, you know, but not doing anything is also doing something, right? If it's just ignored and the blackout gets plowed through and it's just done, well, there's been a fiduciary decision that whatever's happening in the world right now wasn't worth even considering in light of what we had already decided to do. That's probably not the right answer. Probably the right answer is that, you know, the facts and circumstances are considered, the reasons for the blackout, the reasons for the change are considered, and a determination is made as to whether or not it's prudent to continue or whether it's prudent to delay or make some other change. You know, this may be easier in certain cases, like, you know, if you have a plan sponsor initiated blackout, essentially because like there's a planned merger, well, and it's not particularly time sensitive. Well, you know, to me, you know, it kind of seems like, well, of course that can be delayed. But other decisions, you know, may be harder calls, or at least if they're not harder calls, I would suggest going through the process and documenting what you're doing and why you're doing it, as opposed to just ignoring it. A little bit more on plan investments on the next slide. Just a couple things to consider here. I mean, the only thing I'll really point out here is, you know, be careful. Take a look at your investment policy statements. Sometimes they have tripwires in them, maybe requiring certain allocations or certain types of investments, in particular in defined benefit plans, or they have certain ranges. You know, just kind of keep an eye on that. Hopefully have a process. You should have a process by which that's monitored. Keep an eye on that, because sometimes those automatic triggers may not necessarily be what you may not want them triggered right now. The fiduciaries may not want them triggered right now. And so you may want to modify your investment policy statements. Ed?
Thanks, Dominic. And our last slide, we just wanted to remind folks to consider your service provider arrangements. Think about, you know, their employers as well. Their record keepers are facing unprecedented surges in contacts and issues and participant reach outs. So it's important to engage with your service providers really to gauge their ability to continue the necessary services, get confirmation of kind of emergency work plans and address other issues. But I think truly the message is engage with those service providers. Consider also what educational services or materials that they may have to offer participants. Again, there are a lot of participants sitting out there watching, those not impacted by, you know, workforce reductions or furloughs. You know, they're watching their account balances drop, and they have watched them drop over the last month. And they may be considering taking action and locking in those losses. So consider what sorts of educational materials may help kind of calm and soothe their nerves, and hopefully take a step back to prudently evaluate whether changes are appropriate at this point. And then finally, look at your service agreements for provisions related to business disruption, force majeure clauses, performance guarantees, and just take stock of what those provisions have to offer. Well, with that, I know we are just over 1 o'clock, and so that brings to a conclusion our presentation.
Yep, thanks, Ed. So we'll begin the Q&A session now. We will address any questions that have been submitted, you know, through the question box during the remaining time. If you have any additional questions after today's webinar, please email or call your regular Thompson Hine lawyer, who will direct you to the right person depending on your question. If you are not a current Thompson Hine client, please contact one of us, and we'd be glad to discuss your options with you and your question. And with that, you know, I see we have a couple questions. Ed, I could take a first stab at them, and then you can let everybody know if you disagree. The first question is, has there been any discussion regarding reinstatement of the Roth recharacterization provisions, you know, for example, for 2019 conversions? And I think what this question is referring to is the Roth recharacterization that was actually eliminated from the Internal Revenue Code in the Tax Cuts and Jobs Act. And, you know, so it's been eliminated by Congress, essentially. So In terms of reinstating it, it would require an act of Congress to reinstate it. To my knowledge, there have not been discussions. I have not heard of discussions to do that. And I think the current plan, when the House is still debating. To my knowledge, nobody has stood up and demanded a quorum yet. But when they're done with whatever their process will do over the next day or two, if it takes that, I think that they are out of session for a while, and the Senate is as well. So I don't expect anything on this, but of course we don't know for sure. Another question for the coronavirus distributions: can a plan set a lower maximum amount, or if we adopt, do we have to allow the full $100,000? My interpretation is that you can have a lower amount. These are, my interpretation is that these are permissive. The distribution is a permissive option. The plan loan changes, for the most part, appear to be permissive, with the exception potentially of the forbearance for affected individuals, and then they have to tell you. But, as a permissive provision, you could do 50,000, you could do 20,000, you could do you could do other things too. I mean, assuming that they're consistent with non-discrimination and other requirements, you could say, $100,000, but no more than X% of an account balance or something like that. That would need to be analyzed. But certainly it seems to me that that's those types of things are options that would be available. Ed?
Thanks, Dominic. Yes, and I agree with both of your comments and your answers to the questions that are posed. I would just reiterate that it's not entirely clear on the face of the act and the provisions, the mandatory versus discretionary election to put in place these provisions, but that seems to be the case, that these are optional provisions with the caveat that Dominic mentioned. And I think those are all of the questions that have been posed at this time. So I think we're going to end at this point. If there are additional questions that come up after our call, please feel free to reach out. If additional questions arise, please email or call your regular Thompson Hine lawyer, who will directly direct you to a member of our COVID-19 task force. If you are not a current Thompson Hine client, please contact one of us and we can discuss with you options to address your needs. If you're not currently receiving our updates and invitations, we invite you to go to the Thompson Hine website and register to receive our mailings under the Publications tab. We issue regular updates on a variety of topics, including the coronavirus. Thank you all for your interest in attending today's webinar. Enjoy the rest of your day and stay safe.
Thank you.